Hello, I'm Mel Jones. Thank you for watching our third segment of How to Sell Your Restaurant. This one focuses on valuing your restaurant. So let's start. First of all, valuing a restaurant is more objective than subjective. It truly is a science. Don't let anybody else tell you that it is an art. There are numbers that you apply to this, and I'm going to walk you through the process and a logical process to get you to how much your restaurant is worth. You've probably read that there are generally 4 ways to value your restaurant. First is revenue percentage. Second will be discretionary cash flow. Third would be the cost replacement. And the fourth will be capitalization of the earnings. For purposes of this video, I'm just going to focus on the cash flow method because that's the only method that the banks use, and that's the ones that professionals should be using. It's a little more technical, and it requires somebody with financial skills and being able to read tax returns, profit and loss statements, and balance sheets. So make sure that whoever is doing this, including yourself, you have a thorough understanding of how everything flows. The cash flow method is often referred to as seller's discretionary cash flow, or it's also described as what a working owner puts in his pocket before he pays himself anything, including the perks. Some of these perks would include your salary, car, medical insurance, car insurance, entertainment, anything that has nothing to do with really running and operating that business. All those items get back into the earnings that we're going to look at. So we need to do a financial analysis using the tax returns and the profit and loss statement along with the balance sheet. The first step is to take the net income from the tax return. Let's say it's $90,000. Then what we go through is the tax return and identify the items that are very obvious. The first one will be the owner's salary. We add that back. The second one will be car expenses. We'll add that back. The third one will be medical insurance. And also travel and entertainment are often added back. There may be other things in there that can be added back, but often people buy their food and put it in their cost of sales. Good luck with that one. The bank won't accept it. You might be able to convince a buyer to accept it, but the bank won't accept it in its calculations. So be careful with that. Then finally what we do is we will add back the non-cash items such as depreciation and amortization. And then finally we'll add back interest because the buyer isn't acquiring your debt, and we're trying to get what the cash flow is before any payments to the bank. That's our objective. So when we add all these things up, it comes up to a cash flow of $233,000 for this particular restaurant. Okay, so now we got a number. What are we going to do with it? The next thing we got to do is we got to evaluate the business itself. And I evaluate that business based upon 4 factors. Factor number 1 is revenue. Is the revenue growing? Is it flat? Or is it declining? Factor number 2 is the costs. Are you managing the costs properly? Are we in line with our food costs, our labor costs, our rent factor? Or are those within the industry? Or are they outside of the industry? Or are they better than the industry? Factor number 3 is the lease and the location. Is it a great location? Lots of foot traffic, lots of car traffic, plenty of parking going on, a lot of activity center? Or is it dead? Or is it a destination location? And also, is the rent fair? You gotta look at the rent per square foot. You gotta look at the rent per the percentage of sales that it's generating. It's really important. If you're generating 6% cost factor on the rent, that's great. If you're generating 10%, 15%, not good. Not gonna get a good score on that one. And finally, it's the condition of the restaurant. How good a shape is that restaurant? How well have you maintained it? Does the kitchen look like it's good? Are you maintaining the equipment? Is it very clean? Is the front of the house, all the seats in good shape, or are they all torn up? So those are the 4 factors that I look at. And then what I do is for each factor, I give it a score between 1 and 6. So we want to look at each one of these 4 factors and give them a score. The scoring is from 1 to 6, 6 being great, 1 being not too great. When I score each one of these things, I'm going to total them up, give it a weighted average, and then I'm going to apply a factor to it to determine what the multiple is for this restaurant. Let's look at the revenue factor. Number 1, let's assume the revenue is going up at a good clip and it's fair. So this one, I'm going to give it a 5. Then let's look at the lease and location. It's a great lease, great location. They're running a little high on their rent factor of 8%. So because of that, I'm going to score it a 4. Then let's look at the condition of the restaurant. The restaurant's in pretty good shape, a little wear and tear here and there. The floor maybe not so good. So I'm going to give this thing a factor of 4. So finally, let's look at the cost factor. Let's say the costs are running 33% on the food and 35% on the labor. That's a little high. I like to shoot for 28 on both, and I would probably give this a score of perhaps 4 out of the 6 on this factor. So then what I do is I take all 4 of these factors, add them up, divide by 4 to get a weighted average. In this case, the weighted average came out to 4.25. So you go, what do you do with that number? Well, I'm going to show you what you do with that number. So what you do with that number is, there's a matrix that I've developed over time in 16 years of experience. You look down this matrix and you see 4.25 gives a multiple of just a little bit more than 2.5 times cash flow. In this case, 2.6 to be exact. So you take the 2.6, multiply it by the cash flow, which was $233,000, and you get a number that's slightly north of $600,000 value for the restaurant. So that's how you value your business. Obviously, it's technical, it's detailed, but if you do it a lot, it's become second nature. But these are important things that you need to understand on how to value your restaurant. If you need our professional service to value it, give me a call. We do that as a consultant basis. Thank you for staying with me for this complex transaction of valuing a restaurant and hanging in there. Hopefully you learned a little bit. I look forward to seeing you in our final episode, episode 4, where we're going to go through and sort of tie it all together and get your restaurant out there for the highest value you possibly can get.